Hello friends, a very warm welcome to my channel. In today's video, we are going to analyze a public sector enterprise. So we are analyzing a public sector enterprise after a very long time. And this company also we have picked up from the comment section in the previous video. So the company which we are going to talk about today is Cochin Shipyard. This company manufactures different kinds of ships or vessels. It is into defense as well as commercial ships. And this sector has come into limelight post-COVID, and the company has a massive order book. We'll talk about it in more detail soon. So if you're new to the channel, please do subscribe and hit the bell icon to get updates of all the new videos which I upload. And if you're not a part of our Telegram channel, do join today. It's a free channel. Every day morning before the market opens, I share my views on the markets. I discuss my cash allocations, which will help you improve your portfolio returns. So let's begin the analysis of Cochin Shipyard. This will be the flow of our discussion. We'll talk about the business model in brief. We'll look at the chart, how the stock has performed the last few years. We'll talk about the main financial parameters. We'll discuss why the stock has rallied so much post-COVID. We'll see what is the outlook of the management going forward. We'll talk about the valuations. We'll discuss what are the risks of investing in this business. And then we'll form an overall view on the company. Cochin Shipyard is a public sector enterprise started in 1972. It is into construction as well as repair of all kinds of vessels. So when we say all kinds of vessels, it includes tankers, bulk carriers, passenger carriers, air and defense ships also. The company not just makes ships for the Indian Navy, it also exports vessels abroad. In terms of segmental revenue, nearly 75% of the revenue comes from the construction of ships and 25% from the repairs and maintenance. So the stock was consolidating for a very long time pre-COVID, and post-COVID it gave a massive rally up to 3000 levels. And as the valuations became very steep, there was a sharp correction in the stock, and now it trades at somewhere around 1500 levels. And at the similar range, the government has also done a OFS recently. So now at 1500, it has paused for a while and trying to build a base at this levels. If you look at the revenue in FY21, the company did a revenue of about 2,800 crores, and in the trailing 12 months, they have done almost 3,900 crores. So although there has been a steady rise in revenue, except in FY23, still the revenue growth has not been very impressive. If you calculate and check, it is a single-digit revenue growth on an average, which is not great from an investor's perspective. In terms of EBITDA, it did an EBITDA of about 700 crores in FY21 and around 975 crores in the trailing 12 months. And EBITDA also has not been very consistently growing in the last 5 years. The margins have remained good. There was a dip in the margin of 12% in FY23, which bounced back to almost 24-25%. But going forward, the company is guiding that the EBITDA margin at a consolidated level will remain in the range of 70 to 19%. So it is guiding for a compression or lower EBITDA margin going forward, which may have some pressure on the profits of the company. So historically, if you calculate the sales growth in the last 3 years, 5 years, it has been in single digits. The inventory days have increased, which is a concern if the working capital is not managed very efficiently. And the profits appear high at a PAT level because there is an element of other income of around 300 crores in FY24. The company has good liquidity. They are sitting on a cash of almost 3,700 to 800 crores. And recently, the government did a open offer at 5% stake and sold it at around 1550 rupees. So what led to the massive rally in the stock in the last few years post-COVID? The sector came into the limelight and there was a lot of order book which got built up. And these public sector stocks which were ignored for a very long time in the last couple of decades got some traction, and the re-rating of the valuation multiples happened drastically. Now, what are the growth plans of the company going forward? There are a couple of big capex plans which the company is presently executing. They are building the largest dry dock port project, and this project just got commissioned in October 2024, and they've spent close to about 1800 crores for this project. Another international ship repair facility got created by this company by spending 970 crores, and partially it got operational in August 2024 already. For FY25, the company is guiding of revenue growth of about 20 to 25% and EBITDA margins of around 18 to 19%. But the PAT may be impacted because of these recent capex. The depreciation may impact the profit after tax. They've also done a contract with a European client to manufacture hybrid vessels. So you see that the company is moving upwards in terms of technology and moving towards electric vessels, hybrid vessels, etc. So this is a new hydrogen fuel cell vessel which the company has developed. It's a pilot project done by Cochin Shipyard. And if this works out well, the company may get a lot of traction in this product. This is a fully electric catamaran ferry which the company has developed. An autonomous service vessel project which the company has developed. There is nobody driving this vessel, and these are designed for specific tasks like patrolling or weather forecast and all that. And it is programmed to sail and do the task on its own. So you can see that Cochin Shipyard is also working towards newer technologies along with the traditional shipbuilding which is being done. When we come to order book position, compared to the existing revenue, the order book position is quite massive. They have an order book of almost 22,500 crores and about 1000 crores for the repair and maintenance. Apart from this 22,500 crores, the company is also bidding, and there's a pipeline of orders of about 7,800 crores already. So the visibility of growth in the near term for the company looks strong. Now coming to the valuations, which is another interesting part of this video. Earlier the company used to trade at somewhere around 10 times the earnings, and now it got re-rated to almost 45 times in the trailing 12 months. It went to as high as 90 times recently. In terms of price to book, it is trading around 8x and market cap to sales about 10x. So you can clearly observe that the re-rating in terms of the valuation multiple has already happened for this company. And valuations of earnings multiple of 90 PE was not sustainable, and that's why it is getting normalized now. So what are the risks of investing in such a business? In case the government spend becomes less, in case the order flow goes down, the sector comes to a slowdown, it could be a big challenge. Valuations are not very attractive at these levels, so it is a risk from an investor's perspective. Getting an order book is one hand, execution, timely execution, profitable execution is another. That has to be closely monitored. If the government policies change, it is a regulatory risk for this company. Working capital has to be efficiently managed as the inventory levels are going high drastically. And there will always be an overhang of OFS by the government in case the government wants to cash in and use these funds for other countries' development purposes. So now that you've understood the business of the company, you've understood the valuations, the growth part, you've looked at the financials, understood the risks of investing, what is the overall view on the stock? So if you're already holding the stock and if you have not exited at the higher valuation levels of 80-90 times, then you may still give it a chance and wait for some more time for an upside to exit. But if you're looking at a fresh entry in the stock, you can observe that the order book is strong, but the execution wise, the sales growth have not been so impressive. And going forward also, the company is guiding for about 20-25% growth in FY25. So at the current valuations of 45 times, which also includes an other income of about 300 crores, the valuations are not very attractive. So if your expectation as an investor is moderate returns, looking at the order book, you can consider an entry. But if you're a high growth, high returns investor, at the present valuations, the stock doesn't look very attractive. You can give it some more time, let it make a technical base, and then evaluate it after a few days. It may take quite some time for the public sector stocks to breach their earlier highs and make a fresh new high. And they may consolidate for some time and build a base. So that's about Cochin Shipyard. I hope you like the crisp analysis. I've tried to cover all the important points in this video. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, do mention the names of the stocks in the comment section. Do join our Telegram channel. It's a free channel to be in touch with me on a daily basis. Thank you for watching and have a wonderful day.